Can you see the screen? Okay, so this is the, one of the main topics of income tax. The topic is income under the head profits and gains of business or profession. Okay, so basically, whenever you are doing business, whether you are a company, whether you are a proprietor, whether you are a foreign company, any businessman, this is basically, how he is going to compute his tax. Whatever his form, whether it's a sole proprietor, whether it's a partnership, whether it's a domestic company, foreign company. Okay, so this is for, or even for professional lawyers, CAs, chartered accountants, doctors. So this covers, all kinds of, people who have to file their return. Okay, fine. Normally, these people, or normally the last date of filing the return is 31st of July. But for business people who are having a very good turnover, who are subject to tax audit, they can file it by October or some other date. Okay. So anyway, we are not discussing that at the moment, but we are discussing how they compute their, tax return, how they file their tax return and how they compute their taxable income. All business entities, they are required to prepare a profit loss account. Profit loss account, you are all aware of? Yes. Have you seen a profit loss account of any company? There? Okay. So that means you have to make a profit loss account. Okay. Now, the net profit, so this is a pro forma basically. The first we are talking about, how the pro forma will look. Pro forma for computation of income under the head profit and gains of business or profession under the default tax regime under section 115 BAC. That means they are not going to claim any deductions, exemptions. Okay. And this is the default regime. If they can also file a return where they can claim all the benefits which are given by the government. Okay, so then the tax rate is different. Then the tax rate goes up. Okay, so I'll talk about the tax rates later on. So the process is, first you take the profit as per the statement of profit loss account. How much profit the company has declared, in their profit loss account. Now the companies, they are supposed to make their profit loss account as per the Companies Act. So there is a schedule there, and they have to follow all the provisions of the Companies Act. Okay, even the depreciation rate are given under the Companies Act. Okay, and they have to follow them in their books of account. And before they can declare dividends, because if the company is profitable after writing their books as per the Companies Act, they can declare dividends, or they can pay even remuneration to the director or to the managing director. So that means they have to follow the norms of the Companies Act in case if it's a company. Okay. So we'll start, the top line is that you start with net profit as per the statement of profit loss account. Whether it's a company, whether it's a sole proprietor, or it's an individual businessman, whether it's a CA or a lawyer or a chartered accountant, anyone. So he's going to make his profit loss account. Okay. So he'll show some amount of profit. So then you do certain adjustments. First, you add expenses debited to statement of profit loss account but not allowable. So certain expenses, so just focus, this is a very important part we are just doing. Okay. So the first you have to show what is the profit the company has earned as per the income statement. Okay. Then there are certain expenses which are shown as an expense in the income statement. The income has been reduced and shown less, okay, because those expenses have been debited, but they are not allowed under the Income Tax Act. The main one thing which I can talk about is some personal expense, like there is a owner of the company, and owner plus the wife of the owner, they had gone to some kind of a business visit, and the ticket of the wife is also been included as expense. So that will be disallowed, okay, because that's a personal expense. Fine. So any expense, I'm just giving you a very small example so that you understand what is the nature of the expenses which are not allowed. Okay. So what are some expenses which are not allowed? So we'll do, this is the details statement. Okay. Fine. So this covers most of it. First is expenses debited to statement of profit not allowable. First, depreciation as per the books of account. Now the depreciation is as per the Companies Act. Okay. So that is disallowed. That means what is allowed? Depreciation as per the Income Tax Act, because income tax has its own rates. Okay. Normally they are far higher than the Companies Act, because that is to promote investments. Okay. So income tax government promotes the companies to charge higher depreciation. They can reduce your income and pay less tax. So that was the kind of a old thing. Now with the new regime, They are just taking away all those exemptions also. Now I'm just coming to expenses of excessive unreasonable payments to related persons. Now, for example, you have hired one of your relative to do the job and you are paying a salary of 1 lakh to him. Otherwise, his market salary would have been, say, 25,000. But you are paying 1 lakh because he is relative of the director. Okay? So that expense will be disallowed. And how it is done, we'll discuss that later. But if you have paid more than the fair value, what is due to the relative, you have to disallow that. You do it yourself. The income tax says instead of we calling you, you do it yourself. Otherwise, we will call you and disallow you, and you have to pay some penalty and interest on that. Okay, fine. So excessive unreasonable payment to related persons are disallowed under section 40A2. Okay, fine. Then payment above 10,000 made otherwise than by account pay electronic mode are disallowed. So if you are making a payment to someone in cash, okay, you can make a payment up to 10,000. But if you make a payment above 10,000 in cash, even if it is your genuine expense, it will be disallowed. So income tax department says that all expenses have to be incurred through account pay check or online transfers or UPI, whatever. Okay. Then unpaid statutory dues like GST, ESI, Provident Fund, all the companies are supposed to pay Provident Fund, okay, and ESI, that is Employee State Insurance Schemes, okay. Some retirement benefit they have to give to the employees, and they are supposed to deposit some money into certain authority, and even like GST, okay. So if the company has not deposited GST with the government, they can't claim this as a reduction. Okay, so that will be straight away disallowed. So all statutory dues which you have not paid will be disallowed. Okay, they will be allowed, only when you make the payment. So that means if you have not paid it, then you claim it next year. Okay, fine. Then payments to micro, small, and medium enterprises. If you are dealing with small companies, which are micro companies, small companies, and if you are buying something from them, and if you are not making payment on time to them, okay, normally the time is, if it is unspecified, within 15 days you are supposed to make a payment to small companies. But if it is a written agreement, that can be maximum 45 days. Okay, I'm just giving you this thing, but you don't have to remember that. So you have to just remember that all small and medium micro companies, you are supposed to make the payment on time. Okay, fine. If you don't make, they will be disallowed. So this is basically to protect the small companies. If the big companies, they have to make the payment in time, otherwise they will be added to their income and they have to pay more tax on that. Okay. Then personal expenses disallowed. Okay. Any personal expense which I told you is been debited to your profit loss account, that will be disallowed. Then fine penalty for breach of law. That means if you have paid any penalty fine to government for not meeting out certain law, then that is not allowed as an expense. That has to be added back. Because when you make a profit loss account, you are going to show the expenses, penalty paid to so and so authority for not meeting out certain obligations, okay, of the law. So that penalty will be disallowed. That will be added to your income, and the company is supposed to pay tax on that. Okay. Now there are certain things which I missed out. Income tax paid. Now income tax is not an expense. It is only calculated after you have calculated what is your net profit as per the Income Tax Act. So that is not an expense. Okay. If you have included that income tax in your profit loss account as an expense, exclude that. Okay, because that you are not supposed to take as an expense. So add back that, because the tax will be calculated on your net income before paying the tax. Okay. Suppose you have paid some tax as an advance tax, so that means you have to exclude it from the expense. Then 30% of the sum payable to residents on which tax is not deducted at source. Now in India, if you are paying some money to someone, like to your employees, or like I am a visiting faculty, so shivnadar, when they make the payment, they deduct a tax at source, say 10% from my payment. Or from the employees, they deduct 10% or whatever is their salary, they are going to deduct that. If they don't deduct that, or if they have deducted but they have not deposited with the government authority, 30% of the amount will be disallowed straight away. Okay. It will be allowed only when they make the payment. So that means if they are filing the return and they have not paid it, that will be disallowed. But in the next year when they pay, it will be allowed. That means it will be shifted to the next year. So that is a penalty for this thing. Okay. So these are only, that's all. So expenses debited to profit loss account but not allowable. So remember them, they are like personal expenses or PF, ESI or statutory dues like GST if you are not deposited money in time, so that will be disallowed. Okay. Now less expenditure allowable as deduction but not debited to the statement of profit loss account. There are certain expenses which are allowed as expense, but you have not shown that as an expense in your while calculating your profit. Like for example, in depreciation as per the income tax rules. So you are allowed to that. So you can reduce that because you have already added the depreciation as per the Companies Act. Now you need to reduce depreciation as per the income tax, okay, to calculate your exact profit. So let's see what is that. So the first item is depreciation as per the income. Allowable deduction is not debited to profit loss account. So depreciation as per the income tax rules, 30% of the expenditure disallowed earlier will now be allowed. Suppose in case you have now deposited the tax, you have, suppose, the TDS has not been deducted. Like suppose I am working at Shivnadar. So the Shivnadar has deducted income tax from my salary or from my wages or whatever, and they have not deposited. So it will be disallowed. But if they now do it, so next year they can claim it. So that 30% will be allowed in the year when the actual payment is made to the government. Okay. Okay. Similarly, any statutory dues, if they are not paid in time, so they will be disallowed, like ESI, Provident Fund or whatever. So they will be allowed in the year of actual making the payment. Okay. So less income credited in statement of profit and loss account but taxable under any other head. Now if you have shown some income in your profit loss account, okay, but it is not your business income, okay, it's like you have earned some, for example, it can be like a dividend received on some investments. So dividend is income from other sources. Similarly, interest on saving account or fixed deposit are income from other sources. There are 5 heads, so this will not be taxed under this head, okay. So it will be shown under income from other sources. So if you have shown any income and it has been reflecting your net profit, so first you have to exclude that and then you have to add it and pay tax on other sources, income from other sources. So income credited to this thing. So let's see what are those. Like dividend income, okay. Income credited to profit loss account but not taxable under other heads, like dividend income, agriculture income. Now agriculture income, we know in India it's totally taxable, not taxable. So it will be removed, okay. So if you have shown that agricultural income in your profit loss account, which will not normally show it because you have earned some money, but while paying taxes, it has to be excluded. So income credited to profit loss account but not taxable or taxable under other heads like agriculture. Interest income on fixed deposits. Capital gains. Now capital gains are taxable under the head capital gains, so it will be disallowed. It will not be. Now then if you earn some rent on giving a property and you are earning some rent, so that's a separate head which we haven't done. So we will be doing 2 more heads remaining, which we will be doing next Saturday, and we will be covering all the syllabus. Okay. So income from capital gains, income from house property. If you have had a property which you have let it out and earning some rent, so that will not be included in your business income. Okay. Like winning from any lottery. Suppose you have got some gift or horse races. Some people maybe making some money on account of lotteries or horse races or gifts. Suppose somebody has received, some company businessman has received a gift, okay, or income tax refund. So all these are basically, they are credited to profit loss accounts, but they have to be excluded while computing your income. Okay. So income tax credited to statement or profit loss account, but not taxable under taxable under any other head. Either not taxable like agriculture income or taxable under a head, like for example dividend is taxable from other sources, or capital gains from under the head capital gains. Now the last one, that's all, and then we'll simply do a question straight away. Income chargeable under this head oblique deemed income if the same is given as additional information has not been credited to statement of profit loss account. Now suppose there can be some income which has not been shown as an income, okay, which is called the deemed income. Now for example, I'll give you some example that you had written off a bad debt, okay, That means your customer was not paying. First, normally you make a provision and then finally you write it off from your books. You show as a bad debt. You showed it as a bad debt, but after 3 years, the customer actually paid the money to you. Since you have already claimed as an expense under the income tax and paid less tax in your earlier years, so that bad debt will be classified and shown as an income. So that will call your deemed income. Okay. So that can be one very simple example. So let me just go here. So it's coming bad debts here. Add deemed incomes, other income not credited to profit loss account, like bad debts. If you have not shown this, if you have already shown it, then it's okay. If you not, if this money has been received by you and you have shown that as a bad debt is not as in the line item, so you then add it. Okay, you have to pay tax on that. Okay, as a business income. Now, so these are tax rates. I'll come to that. Now, these are the depreciation rates. As per the Income Tax Act. As per the Income Tax Act, all the assets have been classified as blocks. All the assets are classified as block. All individual items are not capitalized. It's as a block, they are capitalized, and there is a rate of depreciation for each block. For example, just for your information, the block number 1, building which are mainly used for residential purposes except hotel and boarding houses, 5%. If you are owning a building as a businessman and that is used for the residential purpose of your employees, so on those buildings you are allowed 5% depreciation. Okay. Fine. Of course, there will be no question in the exam. I'm just sharing that. Then the block number 2, buildings which are not, maybe on one quiz which may have last quiz, so we may have this. Okay, so you remember that. So buildings which are not used mainly for residential purpose, then the depreciation rate is 10%. Okay. Normally, any building owned by any company, okay, or any businessman, so which is not used for the residential purposes of the employees, the depreciation rate is 10%. Okay. So this is the normal depreciation. Now, the block number 3 is basically, block number 4 is purely temporary erections like wooden structures. They are buildings, but you made us go down. Okay. So 40% depreciation because life is very less. So that's why they are charged higher depreciation. Now, furniture, like the furniture of this thing. So Shivnadar is claiming depreciation on the furniture and then paying the income tax. The rate is 10%. Okay, fine. Then motor cars, the rate is 15%. There is a 30% motor car rate. That is only when the motor car is being used for as a business of hiring. Like you're running a public transport or something business. You are giving hire your cars. Then the rate is 30% because then the wear and tear is very high. So otherwise, the motor car is used for the general purpose of doing your business. Okay. For taking your director or partner or your employees home or back. So then the rate is 15%. Then I'm just, there are so many blocks here. Then like plant and machinery, equipments, okay. One thing I just want to show was computers, for example. Computers, block number 15, the rate of depreciation is 60%. Maybe under income tax it is 60%. In Companies Act, it is 40%. That's why there is a difference. So that's why you first add the depreciation as per the Companies Act and then reduce the income tax depreciation, which can be a little more beneficial. Then any books or magazines or like law books for doctors, chartered for lawyers and chartered accountants. So the rate of depreciation is 40%. Then plant and machinery, journal, 15%. Okay. For ships and all, the depreciation is 20%. Then the final depreciation rate is for intangible assets like copyrights, patents. The depreciation rate is 25%. Okay, fine. So this is the rate of depreciation anyway. So let's start with example. Okay,